Have you ever stopped to think that the money sitting idle in your bank account is losing value day after day, like sand slipping through your fingers? While you're working hard, your money might be devaluing by the second. That's right. Today we're going to show you how to make your money work for you. I'll explain where and how to invest in a clear and uncomplicated way so that you can take the first step towards your financial freedom. If you finally want to understand how investments work and how to make the most of your hard-earned money, stick with me until the end of this video. And of course, don't forget to subscribe to the channel and leave a like, because that's the key to making sure you never miss any valuable content from now on. But after all, what does it mean to invest? Investing is putting your money into assets that you expect to appreciate over time. In other words, it's making your money work for you. Many people confuse saving with investing. Saving is putting money aside, while investing is making that money grow. Saving money in the bank is a form of saving, but there are other options that can offer you a higher return. Investing is crucial to achieving your long-term goals, such as buying a house, traveling the world, or ensuring a peaceful retirement. Plus, investments protect you against inflation, which erodes the purchasing power of money over time. Investing can seem complicated. It feels like it's only for those who understand a lot about economics or already have a lot of money, right? But let me tell you a secret. Investing is for everyone. There are several options, from the safest to the riskiest, that suit different profiles and budgets. That's exactly what I'll be talking to you about now. So, don't leave and take this opportunity to share this video with someone who also needs to understand more about investing. Let's start by talking about the most common types of investments in the U.S. Understanding each type will help you make better choices that are more suited to your profile and financial goals. Fixed income. Fixed income in the United States is basically lending your money to the government or financial institutions, such as banks, and in return, you receive interest. Here you know exactly how much you're going to earn, or at least have a good estimate of the return. Examples of fixed income include U.S. Treasury bonds and certificates of deposit, CDs. Fixed income is ideal for those who prefer safety and predictability, being recommended for beginners and people who don't want to take many risks. Now let's list and explain some fixed income investments. Treasury bonds. These are some of the most popular investments for beginners. You lend money to the U.S. government and get it back with interest. There are three main types of treasury bonds. 1. Treasury bills, ideal for those who want an emergency fund as they are short-term and have high liquidity. 2. Treasury notes. Offer a fixed rate, making them ideal for those who want to know exactly how much they will receive at maturity. 3. Treasury inflation-protected securities, TIPS. These bonds are an excellent choice for those who want to protect their purchasing power against inflation, as they combine a fixed rate with adjustments based on the Consumer Price Index. Certificates of deposit, CDs. Here you are lending money to a bank. In return, you receive a fixed interest rate, which can be either prefixed or post-fixed, linked to an indicator like the U.S. federal funds rate. Some CDs offer daily liquidity, meaning you can withdraw the amount at any time without penalties. Municipal bonds. Issued by local governments to finance public projects, these bonds are often exempt from federal taxes and, in some cases, state and local taxes, making them an attractive option for investors seeking tax-free income. Variable income. Now, let's talk about variable income. In this type of investment, you don't know exactly how much you will earn because the return depends on the asset's performance in the market. Variable income includes stocks, real estate investment trusts, REITs, and even cryptocurrencies. This type of investment is for those who are willing to take more risks in exchange for the potential for higher returns. Now let's list and explain some variable income investments. Stocks. When you buy a stock, you're acquiring a small part of a company. If the company grows and is profitable, you benefit from both the appreciation of the stocks and the receipt of dividends, which are part of the profits distributed to shareholders. There are different stock investment strategies. I'll mention two. 1. Buy and hold. Buy stocks of good companies and hold them for a long time, benefiting from their growth and dividends. 2. Day trading. Buying and selling stocks on the same day, taking advantage of daily price variations. It's a high-risk strategy recommended only for experienced investors. REITs, real estate investment trusts. These are real estate funds that allow you to invest in the real estate market without having to buy property. When you buy a share of a REIT, you are investing in a portfolio of income-generating properties, and that income is distributed among the shareholders. There are different types of REITs. 1. Property REITs. Invest directly in physical properties like malls, warehouses, and office buildings. 2. Mortgage REITs. Invest in mortgages and securities tied to real estate financing. 3. Hybrid REITs. Combine investments in both physical properties and mortgages. ETFs. Exchange-traded funds. These funds replicate the performance of an index such as the S&P 500. ETFs are a practical and diversified way to invest in the stocks of various companies at the same time. Cryptocurrencies. Decentralized digital assets, such as Bitcoin and Ethereum. Cryptocurrencies are highly volatile and recommended only for investors who are willing to take significant risks. Besides the most well-known cryptocurrencies, there are altcoins, which are alternative cryptocurrencies, and stablecoins, which have their value tied to fiat currencies like the dollar. Now, I will stop the translation here and continue with the rest of the document. Here is the continuation of the translation, following the same format and structure. Investment funds. Another interesting option is investment funds. In them, several people pool their resources so that a professional manager can invest in different types of assets, such as stocks, fixed income securities, and even currencies. There are funds for all types of investors, from the most conservative to the most aggressive. Fixed income funds. These funds invest primarily in fixed income securities and are a great option for those seeking safety and predictability of returns. Mutual funds. These funds invest in a mix of stocks, fixed income, and other assets, providing diversification. They are managed by professionals who select and manage the assets to seek better returns. Equity funds. These funds primarily invest in stocks and are ideal for those who want exposure to the stock market but prefer to leave asset management to a specialist. Currency funds. These funds invest in foreign currencies such as the dollar or the euro. They are recommended for investors who want to protect themselves from the depreciation of their local currency or speculate on the appreciation of other currencies. Private pension plans. In the United States, you can invest in retirement plans such as the 401k offered by companies or open an IRA, individual retirement account. Both are long-term investments that offer tax benefits. 401k. Contributions are deducted from your paycheck before taxes, and many employers offer matching contributions, meaning the company may match your contributions up to a certain limit, helping you grow your assets faster. IRA, individual retirement account. This is an individual retirement plan. There are two main types of IRAs. Traditional IRA allows you to deduct part of the contributions from your income tax, but withdrawals during retirement will be taxed. Roth IRA. Contributions are made with after-tax money, but withdrawals during retirement are tax-free. This option can be advantageous depending on your long-term strategy. Diversification. Diversification is key to minimizing risks. By spreading your investments across different types of assets and sectors, you reduce the negative impact that a drop in a single market can have on your portfolio. Let's understand some forms of diversification. Sector diversification. If you invest in stocks, don't put all your money into companies in a single sector, such as technology or healthcare. Spreading your investments across different industries helps reduce the impact of sector-specific crises. Geographic diversification. Investing in international assets such as ETFs that track the performance of foreign markets helps protect your portfolio from crises concentrated in a single country while also taking advantage of growth opportunities in other economies. Asset diversification. Don't invest everything in stocks or fixed income. Mixing different assets such as bonds, REITs, stocks, and commodities like gold creates a more balanced and stable portfolio over time. Now that you know the main types of investments, I'll show you how to invest in practice in a simple and direct way. How to invest. The first step is to clearly define your financial goals. This will guide your investment decisions. 1. Short term, 1 to 2 years. If you're saving money for a trip or to buy a car, prioritize safe and easily accessible options like treasury bills or short-term CDs. 2. Medium term, 2 to 5 years. If your goal is to pay for a course or make a down payment on a house, it's interesting to diversify a bit more, including mutual funds or ETFs, along with a portion in fixed income. 3. Long-term, more than 5 years. Retirement and long-term wealth building require a greater willingness to take risks. Here, stocks, REITs, private pensions, and even international investments are good options. Know your investor profile. Understanding your investor profile is essential to aligning your expectations with the types of investments you'll choose. There are 3 main investor profiles. BAS, conservative, prefers security above all, even if the return is lower. The focus is on capital protection, with little or no willingness to take risks. Most of a conservative's investments are in fixed income, such as treasury bonds or CDs, but they may also have a small portion in low-risk mutual funds. Moderate, willing to take a bit more risk in search of higher returns. This profile typically balances their portfolio between fixed income and stocks, investing in both bonds and stable companies. Aggressive, has a high appetite for risk and seeks to maximize returns over the long term. An aggressive investor allocates a good portion of their resources to stocks, small caps, stocks of smaller companies with growth potential, cryptocurrencies, and even alternative investments like venture capital. To invest, you'll need to open an account with a brokerage firm. The brokerage acts as an intermediary between you and the financial market. In the U.S., there are many brokers that offer a wide range of investment products, as well as intuitive and easy-to-use platforms. Choosing a broker. To start investing, you need to open an account with a brokerage firm. The broker is the intermediary between you and the investments you want to make. In the U.S., there are several brokers that offer products with low or even zero fees, as well as platforms that are easy to use and accessible via mobile apps. Here are some points to consider when choosing a broker. Fees and costs. Some brokers charge management, custody, or trading fees, while others charge no fees for stock and ETF transactions. Research and compare options to choose the one that best suits your profile. Ease of use. The broker's platform should be intuitive, especially if you're just starting out. Having an app to invest directly from your phone can make your routine much easier. Customer service and support. Evaluate the quality of the broker's customer service. If you have questions or face a problem, it's essential that the support is quick and efficient. Products offered. Some brokers offer more product options than others. If you want to invest internationally, for example, make sure the broker allows for this type of transaction. Now that you know how to choose a broker, here are some important tips for investing wisely. Important tips. Before you start investing in riskier assets, it's important to have an emergency fund. This fund should be your initial priority and needs to be in a place with easy access and no risk of loss. Some recommended options are Treasury bills, short-term bonds issued by the U.S. government with high liquidity and low risks, making them great for an emergency fund. Money market funds. These funds invest in low-risk assets, such as public and private bonds. They are a good option for an emergency fund as they offer low volatility and good liquidity. Certificates of deposit, CDs. Although they have fixed terms, some CDs offer daily liquidity, allowing you to withdraw your money without penalties. Diversification is key. Remember the concept of diversification we discussed earlier. Diversifying is not just about allocating money in different types of assets, but also in different sectors, markets, and even geographies. Sector diversification. If you invest in stocks, avoid concentrating all your money in a single sector, such as technology or healthcare. Spread your investments across sectors like technology, retail, energy, and finance to minimize the risks of sector-specific crises. Geographic diversification. Diversification can also be done in terms of location. Investing in international assets, such as ETFs that track global indices, helps protect your portfolio from localized crises in the U.S. and allows you to take advantage of the growth in other economies. Asset diversification. A balanced portfolio includes a combination of fixed income, variable income, and even alternative investments, such as commodities or real estate. When one market is rising, another may be stable, helping to keep your portfolio more balanced. Invest regularly. One of the most important habits for building solid wealth is consistency in investments. The concept of dollar-cost averaging, DCA, suggests that you invest a fixed amount regularly, regardless of asset prices at that time. This helps smooth out the effects of volatility and allows you to buy more shares when prices are low. Investing regularly is like going to the gym. If you maintain a consistent routine, the results start to show over time. Monitor your investments. After building your portfolio, it's important to monitor it to ensure it's still aligned with your goals and risk profile. Life changes, and your goals can change too. Here are some tips for monitoring your investments. Broker reports. Most brokers provide periodic reports on your portfolio's performance. Use these reports to assess whether your investments are on the right track. Regular reassessment. Set a period to reassess your portfolio, such as every 6 months or once a year. Ask yourself, have my goals changed? Is my risk tolerance still the same? Is any investment significantly underperforming? Automation tools. Nowadays, there are several tools and apps that help automate your investments, such as robo-advisors. They automatically invest according to your profile and goals, making your life easier and ensuring that you invest consistently. Considering foreign investments. To diversify your portfolio even further, you might consider investing abroad. This can be done practically through international ETFs and funds that replicate foreign markets, like the S&P 500 or the MSCI World. Investing in international markets helps protect your assets against local crises and offers the opportunity to participate in the growth of other economies. Now that you understand the fundamental concepts of investing and how your money can work for you, it's time to take action. Conclusion. Remember that old saying, nothing ventured, nothing gained? Well, in the world of investing, the biggest risk is not starting. Don't put off until tomorrow what you can do today. Even if it's a small amount, the important thing is to take the first step and start building your financial future with security and intelligence. If this content helped you in any way, don't forget to subscribe to the channel and leave a like. That way you'll ensure you continue receiving valuable tips to transform your financial life. And share this video with someone who also needs that little push to start investing. Let's go on this journey together towards financial freedom. The future starts now. Let's get your money working for you. Now, showing on your screen is an amazing video I made especially for you. This video is 100% focused on wealth building. I'm sure it will add a lot of value to you, so click on it and go watch it right now. Do it now. See you in the next video. Until then.